Lucas Roth here. Hey, I just recently applied for a refinance of a 30-year mortgage of a house. And I was told, hey, Lucas, we got this special rate for you. Wait for it. 3.5%. I was like, no. Why was I so mad? It's because I know people were getting way lower rates just a few weeks ago, maybe 2.75% or something like that. So suddenly 3.5%, which historically is a very low attractive rate, just looks like mud to me. And I want to know what happened. How come my money's so expensive all of a sudden? It's not fair. Don't worry. Just stick with me. Watch this whole video. Because what we're going to do is we're going to figure out what happened. How come rates went from 2.75 to 3.5? If we can understand that, maybe we will even have an opinion of what mortgage rates will do in the future. Who knows? Maybe we are that smart. All right. So first off, who says mortgage rates? A lot of people think it's the federal funds rate. It's really, really not. Okay. If my video editing skills are on point, they might not be, but anyways, then you will see 30-year fixed mortgage rate and you will see the federal funds rate. And what you'll see is there might be like a little bit of a correlation, but if you want to know what mortgage rates are going to do, knowing the federal funds rate is not going to help you. Okay. So throw that one out the window. It's not going to help. What will help is this one, 10-year Treasury Notes. Okay. So this one and 30-year mortgage rates go in lockstep. Okay. They are just like tied together, like so crazy tight. So if we want to know what mortgage rates are doing, we need to know what 10-year Treasury Notes are going to do. First of all, what's a 10-year Treasury Note? That's an instrument that the government sells to anybody who wants to buy it. And it's a debt instrument, right? So, depending on the market, the price of those will go up and down and the yield of them will go up and down, right? So it's dictated by the market. So what happens is, I'm going to explain to you the accepted, this is what everybody believed for a really, really long time, many, many decades. And this is what kept governments from selling too much debt, right? From taking on too much debt is this fear, okay? The government feared that if deficits went too high and rose, then the interest that the government would have to pay would go up. That in turn would be passed on to consumers and businesses. And so the cost of borrowing would be higher. So investment would go down and then growth would go down of the economy, right? So governments felt like, if we run up too much deficit, our economy is going to tank. Can't do that, right? Can't be in this like super high interest rate environment. So they would hold off from that. But something happened. You know what happened? You don't know what happened. That's why you're watching this video, man. 2008 happened, okay? And it blew this up because what happened is we borrowed hundreds of billions of dollars to stimulate the economy. And this relationship broke down because our deficit went up significantly, but the interest rates that the government was paying really didn't move. Okay. So all of a sudden people were like, okay, we can borrow lots of money at very low interest rates. We can fund things. We can stimulate things. And there's really very little or no negative consequence at all. So that was life. We kind of made it through the recession. And then what happened was 2020 happened, right? 2020 happened. People were like, hey, we know what to do, baby. We know exactly what to do, except instead of like 800 billion, we're going to do 3 trillion. So in 2020, we passed 3 trillion of stimulus. And this year we're getting ready to do another 2 trillion or very close to 2 trillion. So suddenly we are blowing 2008 out of the water. We're running up a lot of a deficit. And my opinion is that everybody is kind of looking at this and like, you know what? This might have been suspended. This belief of like the deficit being tied to investment, interest rates, etc. might have been suspended, but it didn't go away. Okay. We can't just borrow forever and the chickens are going to come home to roost. I feel like that might be a phrase or something like that. But anyways, ultimately, if we borrow too much and there's too much money in the economy, then interest rates are going to go up. Not only that, but our production is lower, right? Supply is lower. There's bottlenecks. A lot of people still aren't working. Capacity isn't up to what it was. And so with all this money in the economy chasing fewer goods, that's going to drive inflation. Once inflation gets a hold, then the perception of inflation will further encourage more inflation in the economy. So long story short, I might have lost you somewhere along the way, but essentially it comes back to this, right? This is what people are thinking. They're thinking, hey, this like 2.75% nonsense, that's not forever. That's not real life. That was just a little like lucky little stretch that we had there. Really, the market's going to demand more interest. There's a potential for inflation in the future because we've been running at 1 to 2% inflation, and very, very low inflation or close to zero. And that's going to start kicking up to 3, and it could go higher in the future. So people are kind of taking all that into account, and they're saying, you know what, that's not a real number. This is closer to a real number. Now, where is it going to go from there? In my opinion, it'll just drift up. You know, I'm not one of those like people talking about hyperinflation and all that. At least not anytime soon. So I think rates will probably go up a little bit, but 3.5%. Hey man, let me just take my lollipop and go home. It's good enough, man. There's nothing wrong with 3.5% fixed 30-year mortgage. I mean, that's just really good. So thanks for watching the video. Have a good one.